In the autumn of 2022, a 30-year-old billionaire graced the covers of premier financial magazines, heralded as the ethical prodigy who would tame the wild, unregulated frontier of cryptocurrency. He preached a philosophy of extreme philanthropy, lobbying lawmakers in Washington and projecting an aura of radical transparency. Yet, beneath this carefully curated veneer of benevolent capitalism lay an $8 billion void. This was not a story of an unavoidable market downturn, nor was it the result of a sophisticated cyber attack by external actors. It was a forensic masterclass in deception, a digital age mirage built entirely on a foundation of misappropriated capital, shattering the lives of millions who believed they were participating in the future of finance. To understand the anatomy of this spectacular collapse, one must examine the dual engines of Sam Bankman-Fried's empire. In 2017, he founded Alameda Research, a quantitative cryptocurrency trading firm designed to exploit pricing inefficiencies across global digital asset markets. 2 years later, he launched FTX, a cryptocurrency exchange platform that promised institutional-grade risk management and unparalleled security for everyday retail traders. Publicly, the two entities operated on opposite sides of an impenetrable corporate firewall. The exchange was marketed as a neutral, heavily guarded marketplace, while the trading firm was presented as merely one of many independent market makers executing automated strategies on that platform. The reality, buried deep within millions of lines of proprietary code, was fundamentally and criminally different. Forensic analysts later uncovered a bespoke software exemption, a hidden architectural backdoor programmed directly into the exchange's trading engine. This clandestine feature granted Alameda Research an effectively infinite line of credit on FTX. More critically, it entirely insulated the trading firm from the platform's automated liquidation protocols. If a standard user's account fell below mandatory margin requirements, their assets were instantly and automatically sold by the system to protect the exchange from insolvency. The proprietary trading arm, however, was secretly immune to this fundamental safeguard. This architectural anomaly facilitated the core offense of the entire operation, the secret commingling of assets. Commingling occurs when a fiduciary illicitly mixes client deposits with proprietary corporate funds, treating securely held custodial money as a limitless personal treasury. When customers wired traditional fiat currency, such as the US dollar, to the exchange, they operated under the legal assumption that their capital was sitting securely in segregated one-to-one custodial accounts. Instead, billions of dollars in customer deposits were quietly and systematically routed directly into private bank accounts controlled exclusively by the trading firm. The illusion of corporate solvency required a mechanism to artificially inflate the empire's balance sheet, masking the massive hole created by the diverted funds. The solution was the FTT token, a proprietary digital asset invented and minted out of thin air by FTX. Initially designed as a simple utility mechanism to offer trading fee discounts to loyal customers, the token quickly morphed into the fraudulent financial bedrock of the entire operation. The executives retained the vast majority of the token's total supply in their own digital vaults, releasing only a minuscule fraction into the open, public market. By heavily restricting the circulating supply, the exchange could easily manipulate the token's market price upward with minimal trading volume. Alameda Research then placed these highly illiquid tokens on its balance sheet, utilizing a highly aggressive and deceptive accounting practice known as mark-to-market valuation. This method allowed them to record the financial value of their entire massive stockpile based on the artificially high price of the tiny fraction actually trading on the open market. They were essentially printing their own private currency, assigning it an exorbitant, unbacked value, and using it as collateral to borrow real, tangible customer funds from the exchange. The sheer scale of this unauthorized borrowing was driven by an unprecedented appetite for risk, cloaked in the philosophical garb of effective altruism. Sam Bankman-Fried publicly championed this utilitarian framework, which argued for maximizing personal wealth strictly to fund global philanthropic causes. This philosophy provided a convenient, impenetrable moral shield for extraordinarily reckless financial behavior. The internal corporate calculus dictated that any gamble, no matter how legally dubious or structurally unsound, was inherently justified if the theoretical financial payout could ostensibly benefit humanity in the distant future. Guided by this distorted ethical compass, the trading firm embarked on a staggering multi-billion-dollar spending spree using the secretly diverted customer funds. The quantitative trading desk ceased functioning as a market maker and transformed into a limitless venture capital fund, injecting billions into hundreds of highly illiquid, speculative crypto startups. Hundreds of millions more flowed into the American political arena, funding campaigns and dark money lobbying efforts designed to shape favorable regulatory frameworks and buy institutional credibility. Meanwhile, a lavish corporate footprint aggressively expanded across the Bahamas, entirely financed by the unwitting depositors. Executives purchased luxury real estate portfolios, including opulent penthouses and waterfront compounds worth hundreds of millions of dollars. The broader digital asset industry, largely operating outside the stringent purview of traditional financial regulators like the Securities and Exchange Commission, provided the perfect dark room for this operation to metastasize. Without mandatory public disclosures, independent board oversight, or rigorous third-party audits, the true financial health of the exchange remained a closely guarded secret among a tiny cabal of insiders. The structural integrity of this hidden debt machine faced its ultimate fatal stress test in the spring of 2022. A broad macroeconomic downturn triggered a brutal contraction across all global cryptocurrency markets. The sudden collapse of the Terra Luna ecosystem, a massive algorithmic stablecoin project, sent violent shockwaves through the industry, wiping out tens of billions of dollars in speculative value in a matter of days. Major crypto lending firms faced sudden catastrophic insolvency, triggering a ruthless cascade of margin calls and liquidations across the entire sector. Heavily exposed to these crashing markets and carrying massive portfolios of toxic, depreciating loans, the trading arm was suddenly faced with severe liquidity demands from its external institutional lenders. To prevent his proprietary trading firm from defaulting and exposing the entire interconnected web of deceit, the founder authorized a fatal, irreversible escalation. He directed his inner circle to plug the gaping financial holes by quietly transferring billions of dollars more from customer custodial accounts. The theoretical firewall, which had always been a digital illusion, was entirely incinerated to keep the trading arm afloat for a few more months. The fatal blow to the empire, however, did not come from a federal regulator, a sudden audit, or a traditional market crash, but from a leaked internal document. In early November 2022, a prominent cryptocurrency news outlet published a leaked, highly confidential balance sheet belonging to Alameda Research. The document revealed a startling, undeniable truth to the broader financial world. The foundation of the trading firm's multi-billion-dollar net worth was not composed of independent fiat-backed assets or reliable sovereign debt, but consisted almost entirely of highly illiquid FTT tokens. The secret was finally out in the open. The entire financial behemoth was backed by a digital coin invented by its own sister company. Panic is the ultimate unforgiving arbiter of truth in financial markets. Days after the balance sheet leaked, the chief executive of a rival, massive cryptocurrency exchange publicly announced the immediate liquidation of their entire corporate position in the token. This single, highly visible declaration triggered a catastrophic global crisis of confidence. Customers, suddenly terrified of losing their deposited capital, rushed to the platform to withdraw their assets. In a matter of hours, the exchange faced a devastating digital bank run, attempting to process billions of dollars in frantic withdrawal requests from retail and institutional clients alike. The exchange quickly froze, halting all outgoing transfers and plunging its user base into darkness. The requested money was simply not there to be withdrawn. The customer funds had already been spent on speculative venture investments, massive political donations, and Bahamian luxury real estate, or they had been permanently lost in the trading firm's disastrous, highly leveraged bets. The supposedly secure digital vault was completely empty. On November 11, 2022, the exchange, the trading firm, and over 100 affiliated corporate entities filed for Chapter 11 bankruptcy in federal court. The prodigy's seemingly invincible empire had entirely evaporated in less than 10 days. The human cost of the collapse was immediate, widespread, and devastating. Millions of retail investors, ranging from seasoned day traders to ordinary citizens seeking a modern hedge against fiat inflation, found their life savings indefinitely locked behind a frozen, unresponsive digital interface. Small technology businesses that utilized the platform for international payroll and cross-border vendor transfers were abruptly paralyzed, facing immediate insolvency themselves. The betrayal extended far beyond individual shattered bank accounts. It critically damaged the fragile trust that the broader cryptocurrency ecosystem had spent over a decade trying to build with the skeptical public and traditional institutional investors. When seasoned forensic accountants finally breached the digital wreckage to map the flow of the missing billions, they found a corporate governance structure that defied professional comprehension. The new chief executive appointed to oversee the complex bankruptcy proceedings, John J. Ray III, a veteran restructuring expert who had previously managed the historic liquidation of Enron, stated in sworn court filings that he had never in his career seen such a complete failure of corporate controls. There was no centralized, reliable list of corporate bank accounts, no accurate daily financial statements, and senior executives routinely communicated crucial billion-dollar business decisions via auto-deleting messaging applications. The rigorous post-mortem of the exchange revealed that the intimidating complexity of cryptocurrency was merely a modern, sophisticated disguise for a remarkably primitive financial crime. The decentralized blockchain technology, the complex algorithmic trading strategies, and the dense tokenomics were ultimately just highly effective smokescreens designed to blind regulators and investors. At its core, the misappropriation of billions was a classic historical tale of straightforward embezzlement, executed by individuals who genuinely believed their raw intellect and supposed moral superiority entirely exempted them from the fundamental laws of finance and basic human decency. The dark legacy of this fraud and the spectacular ruin of the corporate empire serves as a permanent glaring warning to the modern financial sector. It ruthlessly exposes the lethal danger of placing blind faith in charismatic founders, operating in deliberate regulatory shadows, shielded by the impenetrable jargon of emerging technologies. The billions of dollars that vanished into the ether were not ultimately lost to complex cryptographic failures or unavoidable software glitches, but to the oldest, most predictable vulnerabilities in the human condition: unchecked corporate power, deliberately opaque accounting, and the intoxicating, deeply destructive force of unrestrained hubris.